Upin, Ipin and Apin are triplets that started a partnership called Hi-Pi in 2015. The partnership is a business that manufactures and sells Malaysian dessert, which include ice cream potong, ice cream Malaysia and ice kepal bucket. The company sells their products mainly in Malaysia, but also export their product to other Asian countries. This is the statement of profit or loss and other comprehensive income for the year ended 31st December 2017. This is the relevant information related to the partnership.
However, on 1st May 2017, the partnership welcomed Mail and Hagemaru into the operations. The new profit and loss distribution ratios are introduced, replacing the previous profit or loss distribution ratio, which was based on capital contribution.
On 1st September 2017, Apin left the partnership to start new business venture with Sally. This has led to the profit and loss sharing ratio to be distributed evenly for the partners that remain in the business.
Hence, we can summarize the situation using this timeline, where we can see that at the start of the year, only Upin, Ipin and Apin were in the partnership. 4 months later, on the 1st of May 2017, they welcomed Hagemaru and Mail into the partnership, which brings the total partners to 5 people. Finally, 4 months passes by. On the 1st of September 2017, Apin leaves the partnership, which leaves the partnership with only 4 people. At the end of the year, only Upin, Ipin, Mail and Hagemaru are left in the partnership. Now let us calculate. Before we calculate, we should look at the additional information that are stated here. Firstly, we must make some adjustments to the statement of profit or loss. This is because, as stated in the additional information, there was an unrecorded dividend income amounting to RM5,000. This will make a change to the net profit of the company, which is now RM8,594,943. After calculating the correct net profit, we will now start to calculate the provisional adjusted income and the divisible income for the partnership. To calculate, firstly, we must add the net profit of the partnership with the salary, interest on capital, allowances, depreciations, bad debt written off, donations, and private expenses of the partnership. Here, it is important to know how long each partners are or were in the company for the year to ensure that they are multiplied by the correct duration of months. For example, Upin and Ipin can receive the full annual salary as they have been in the partnership for a whole year, while Apin, Mail and Hagemaru can only get 8 months worth of salary as they were only in the partnership for 8 months for the year. This same method is applied to the calculation of medical allowance. However, interest on capital is a bit different as the percentage of interest of the respective partners must be multiplied by their capital contribution. Only then will it be multiplied according to their duration in the company, while depreciation expenses are taken at their full amount. Donations, partners' private expenses and bad debt written off will be taken at their full amounts. Next, the total that were previously added together will be minus with double deduction and non-business income, where we will get the provisional adjusted income. The salary, medical allowance, travel allowance, interest on capital and private expenses will be deducted from the provisional adjusted income to get the divisible income of the partnership. Hi-Pi is eligible for double tax deduction for employee training program, disabled persons and brand promotion advertising as they are a wholly Malaysian-owned partnership and carries out manufacturing. Next, we will calculate the adjusted income, statutory income, aggregate income, total income, and chargeable income for the partners of Hi-Pi Berhad. From here onwards, the partners will be calculated individually instead of being calculated as a partnership. Firstly, we will divide into 3 periods. Each period consists of 4 months. The profit distribution ratio for the first period is based on capital contribution. In the second period, the new agreement states that profit distribution will be based upon an agreed ratio by the partners. while for the third period, profit was distributed evenly between Upin, Ipin, Ma'il, and Hagemaru. Here, we should again remember that only Upin and Ipin has been in the partnership for a whole year, while the other partners were only in the partnership for 8 months. Hence, we find it easier if the previously calculated divisible income is divided into 12 months. Then, the divisible income for each month will be multiplied by 4 months and then multiplied again according to the respective profit sharing ratio during the period. The calculation for each partners are as follows. We will add the divisible income we have calculated with salary, allowances, interest on capital and private expenses among each partners respectively. We will then get the adjusted income. The adjusted income is then minus with the capital allowance which has been stated in the additional information. Capital allowance is divided based on the last partnership profit distribution ratio, which is even distribution among the partners. This is where we will get the statutory income. Statutory income is then added with non-business incomes allocated to their respective receivers to get the aggregate income. Here we can see that the dividend income from earlier is distributed evenly among Upin and Ipin as stated in the additional information. Approved donations will be deducted from the aggregate income based on the period donations occurred. In example, the donation to Rumah Cahaya Matahari Oh My God Panas Terciduk is occurred during the first period. Thus, the donation is divided based on capital contribution. Next, the donation of dialysis machine to the National Diabetes Institute is divided evenly as per the third period distribution ratio. It is important to note here that only Rm20,000 will be taxable for the donation, as healthcare equipment given as gifts to Ministry of Health approved healthcare facilities has only Rm20,000 as limit. Finally, after deducting personal reliefs of each partners from their total income, the partners will receive their chargeable income for the year ended 31st December 2017.
That is the end of our presentation. Thank you.